Welcome back, everyone, to another episode of witty, biting, and oh-so-sarcastic economic analysis. I don't want to say, I told you so, but really, didn't we all see this coming? Australia's economic outlook is like watching a slow-motion car crash. The latest grim numbers from Westpac Banking Corporation indicate that consumer sentiment has slipped again in January, down by 0.7% to 92.1 points. That's right, we're still languishing below that critical 100-point line, which separates pessimism and optimism, or as I like to say, separates hope and despair. Now, my dear viewers, let's get into the real issue here. It's not just about percentages or surveys, this is a reflection of deeper, systemic problems, and once again, we have our beloved policymakers to thank. So buckle up, because we're diving into the rough seas of recessions, weak currencies, inflationary nightmares, and the age-old buzzword, interest rates. A whopping 0.7% slide in consumer sentiment may not sound like much, but let's be honest, the writing has been on the wall for a while now. It's not like Australia walked into 2023 completely unaware of economic headwinds. So, why, despite knowing the risks, is everything still spiraling out of control? Let's break it down, point by point, like a comedic roast, only, in this case, it's no laughing matter. The Australian dollar has been nosediving, falling almost 8% against the US dollar over the past 3 months. Hardly an inspiring figure. In fact, thanks to this depreciation, the Aussie dollar now competes for worst performer, not just in international markets but in the sad sack club of currencies that just can't catch a break, right alongside the Kiwi. You'd think that policymakers might take note, but no. Apparently, watching your currency get pummeled on the foreign exchange like an amateur boxer at a pro match is par for the course. Consumers are far from blind to this downward trend. With their already fragile confidence, they're understandably spooked. As the Australian dollar continues to falter, the logical fear is that the cost of living could escalate, leading to rising import prices, food inflation, and even more economic pain as purchasing power diminishes. This downturn also reflects a broader crisis in expectations, which feeds into the next pressing issue, interest rates, or more precisely, the baffling uncertainty surrounding them. Interest rates, the gift that keeps on giving, or in this case, taking away. For those just tuning in, the Reserve Bank of Australia raised rates to a stubborn 4.35% in late 2023 to rein in runaway inflation following the pandemic. The idea, presumably, was to cool off the economy just enough to stop inflationary pressures, but, as always, when economic theory meets entrenched political cluelessness, things didn't go as planned. The RBA's aggressive rate hikes were sold as necessary pain to get inflation under control, but much like telling consumers, it's for your own good, before you take their disposable income away, this strategy has a tendency to backfire. As homeowners have faced an ever heavier debt burden, with interest repayments eating away at real wages, those homeowners, who make up a significant portion of the market, are naturally hoping for relief. A rate cut, you say? Don't hold your breath. But here's the kicker, homeowners with mortgages are far more likely than renters or outright owners to expect rate cuts in 2024. Why? Simple. They're literally drowning in debt service costs. Meanwhile, despite the high interest rates, inflationary pressures have remained stubbornly persistent. Essentially, what's happening here is like throwing a bucket of water on a forest fire and wondering why things are still burning. But wait, there's more. Household sentiment has been collapsing for months, and the melodies of recession are playing in the background, yet our Reserve Bank has been sitting on its hands since November 2023. You see, instead of making forward-thinking policy changes to help adjust inflationary pressures, they've opted for the thrilling strategy of wait and see. Oh, don't get me wrong, applying caution during periods of uncertainty can be wise. But, when caution turns into apathy, well, then we're cooking up a recipe for non-recovery. Over the second and third quarters of 2024, Australia's economy has barely expanded. In fact, growth was almost at a standstill, a dismal 0.1% to 0.2% per quarter. Gone are the days of Australia's robust economic engine, now we're trying to record any growth, no matter how lachrymose. Does this weak economic data shock anyone? Hardly. When rates are at 4.35% and inflation is still a headline grabber, people stop spending, debt service obligations spiral out of control, and businesses hesitate to invest. It's economic paralysis. And then, of course, we move to the crown jewel of Australia's financial woes, the property market. Once a shining example of what could go right, Australia's housing sector is now caught in a downward spiral, losing steam. As the property market cools, it brings back memories of the 2008 financial crisis in the US, a crisis driven by speculative exuberance suddenly met by the harsh realities of higher debt bills and falling asset prices. The reality here is that Australian real estate is a precarious structure built on debt, massive debt. And while commentators love to talk about how stable our real estate sector is, based on long-term fundamentals, let's not kid ourselves, when housing prices drop, all those over-leveraged mortgages look a lot worse. When defaults pick up, banks start to wobble. Amid sinking property prices and already stressed homeowners, what are the prospects for recovery? Can people even afford to stomach these mortgage repayments? Or are we on the verge of larger property market corrections? Might I add that, despite a warming global economy, the alarm bells of recession are now ringing, and loudest here in Australia. Let's not forget, inflation remains our stubborn companion, difficult to squash and with no clear strategy to eradicate it. Food inflation, energy price hikes, housing, they're all part of the nefarious combo that is dragging down living standards. Thanks to inflation remaining high, wage growth adjusted for real terms is doing a fantastic job at staying negative. Which brings us to two scenarios: either wages somehow start outpacing inflation, highly doubtful in the short term, or the cost of goods spirals further out of control. Worse still, as families spend exorbitant amounts on energy and rent, discretionary spending falls off a cliff, hammering consumer-facing sectors like retail and hospitality. Prolonged inflationary pressure risks leaving us with a uniquely Australian problem: a low-growth, high-inflation economy. Hello, stagflation anyone, where no matter what policymakers do, costs remain unbearably high, and income just doesn't keep pace. It's an economic nightmare. So, now we come to the slightly awkward question: what could possibly salvage Australia's economic disaster? First, let's address the constant drip of tone-deaf government rhetoric. We've heard it all: short-term pain for long-term gain, market adjustments, and even suggestions that the current economic malaise is transitional. If by transitional you mean, we can't control it, but at least we'll be gone in a few years, then yes, it's transitional. But what we need isn't empty promises, it's action. Australia needs targeted economic stimulus beyond yet another theoretical rate hike or rate cut debate. Pumping liquidity, restructuring tax policy to incentivize growth in vital sectors like tech, green energy, and construction, while relieving some of the cost pressures on households, must take priority. Let's use this as a wake-up call to look into options for stimulating sectors that promise future growth. Focusing on the housing market alone won't produce lasting results. We need a more diversified growth strategy. And please, Reserve Bank, stop starving businesses and people with interest rates from an economic playbook written 100 years ago. Australia's economic future hangs in the balance, and consumer confidence remains in the ditch. We need responses, and we need them now, from both government and the central bank. Let me tell you, my dear viewers, unless we break out of this current malaise of economic management, we're on the fast track to an even more disastrous 2025. The writing is on the wall: declining consumer confidence, faltering currency, property market corrections, and stubborn inflation. It's all happening before our very eyes. The sooner policymakers wake up and confront the structural issues facing the economy, the sooner the average Australian can stop worrying about whether they can afford next month's grocery bill or rent. Without action, all we're getting is more stagnation, more fear, and more people falling further behind. Get ready for the ride, because unless things change, we're in for a rocky economic disaster of epic proportions. Time for a little more competence, a little more foresight, and yes, maybe a little repentance for the economic mismanagement that put us in this position in the first place.